Now, before I get into market commentary and index review and some stocks to watch, I pulled up a daily chart of the Nasdaq Composite because I wanted to make a couple of points. This is a chart of 99 2000. Now I started trading around 96 97, but I didn't really start screening until 98 and 99, meaning going through screens every single night. And the analogy I want to make is back then I was oblivious to a lot of things. I was really dumb back then when I started trading. I'm still dumb now. I'm just a little bit less dumb now. But my point is, I was just screening, finding 5 or 10 stocks every single night, oblivious to the news, oblivious to the index. And I was just taking those positions without, kind of like be dumb and follow price or ignorance is bliss, whatever expression you want to use. That is what I was following. And I had no idea at the time that the NASDAQ composite, which went from whatever it was, 3,000 to 5,000, I had no idea that this wasn't normal for an index to do this because I was fairly new at the time. The NASDAQ 100 was up 92% in 1999. And I was like, oh, that's no big deal. I didn't realize that that's an index, and that meant the average stock in the index doubled. But my point was that the analogies to today, and I really want to stress this point. I'm not saying that we're in a 99 environment and every bull market has to be like 99. And I've said several times, not every bear market has to be 08, 09. I hate when people think every time we go into a correction, it's going to be a disaster like 08, 09, and not every bull market has to end like 99. However, there's two analogies. Liquidity is the number one analogy. Back in 98, 99, we came out of long-term capital, blew up. There was a Russian debt crisis, and the Fed kept rates low at the time, what it was based on at the time, and they were pumping money into the system through the money supply because they were worried about Y2K. For those of you who don't remember, right here on the stroke of midnight, December 31st, 99, they were worried every computer was going to blow up. And to ensure from that disaster, they were doing their own version at the time of QE, but it was more of just keeping interest rates low, keeping money pumped into the system, and liquidity. Now, there wasn't 10 or 15 news channels covering this all the time, and there weren't thousands of bloggers and social media for everyone to bitch about what the Fed was doing. My friends and I talk about ignorance is bliss. We were just trading stuff. We were trading AOL and Qualcomm and Dell and Cisco, and we were doing well and just really weren't focused on all the noise and all the garbage. And the analogy to today with liquidity is that the Fed is pumping tons of liquidity into the system, not obviously because of Y2K, because they want to make sure that the economy recovers from the coronavirus. Now, whether we agree with it or not is not the point. That's not our job to fight the Fed. Our job is to interpret the markets and take advantage of it. And when I fast forward to today and reset the charts, this is the current NASDAQ composite. Over the past 2 or 3 months, since we had that fall through day in early April, I would say almost every single night I have screened, I have found 5 or 10 or more stocks setting up. And the analogy, as I said, is two things. Liquidity back then, I think the liquidity now is on steroids compared to the liquidity back then. Again, like it or not is not the issue. Let's take advantage of it. And number two, the second analogy is I was just screening back then, finding stocks and taking the ideas, very oblivious as to what was going on. And you might say, well, that's very dangerous. No, because when the warning signs showed up and there weren't stocks setting up and there was distribution and the averages started to break down, I stopped myself out and I got out. So tonight when I was going through my screens, I found about 20 stocks, which I'll get into in a minute, but I'm just making the point that I continue to screen and find ideas. They are breaking out. They are working out. If you remember from the educational videos, that's a sign of a healthy market when growth stocks are setting up, breaking out, holding their breakouts, offering secondary buy points, and then more stocks are coming behind it. So I'm not sure how long this is going to last. I know that the Fed's not raising rates and doing anything till the end of the year. Who knows? We take this day by day, but I just want to encourage people when you're finding setups Until these warning signs show up, even if you're not comfortable buying certain stocks, maybe taking smaller positions, take advantage of this because the stocks keep setting up and the market continues to act well. Will we have shakeouts and pullbacks and corrections along the way? Absolutely. Even when you look back at, let me go back really quick to 2000. Even when you look at this uptrend, you can see that the NASDAQ along the way, just like it's doing in this current market, had pullbacks to the 21 EMA. With an occasional pullback, it still held the area of institutional support with one pullback to the 50-day along the way up. And going back to today's market, that's what we're seeing are these pullbacks to the 21-day and along the way up. So, of course, we're going to have pullbacks along the way, but sentiment is so muted with the market at new highs. It's just very shocking because normally as the market goes up, people get more bullish. And I think that sentiment is what's going to keep us from any sort of sustained downturn. And again, my job is to interpret this on a day-by-day basis and be flexible. So I will do my best because I know a lot of people are worried that this is going to end and they're worried about getting caught. The warning signs will show up and I'll do my best through these videos to update you when I see them, when I'm reducing exposure, and keep you updated on as that happens on a day-by-day and week-by-week basis.